Heya Cryptozens, it's 10 p.m. Pacific time. The date is October 17th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host as we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. It wasn't all that long ago that we were counting down until Ethereum's merge. Okay, well, that's over. Now what? The answer is the Shanghai upgrade. Now, this will be the first upgrade since the merge happened. So the first one since Ethereum transitioned from proof of work to a proof of stake consensus mechanism. And it's expected to take place sometime next year. So not nearly as long a project as the merge was. It was like 2.5 years. And so it came to pass that we drew one step closer to seeing this upgrade happen. Because they've deployed a testnet. And the Shandong testnet, as it's called, will be essential to launching this upgrade, whatever it includes. Paratosh Jayanthi is a DevOps engineer at the Ethereum Foundation, and he said, quote, "The Shandong testnet is meant to give developers a chance to try to test out the potential EIPs to find issue." Now, right now, there are a number of Ethereum improvement proposals, or EIPs, being considered. They're looking for things that address scalability and efficiency issues. Probably the most eagerly awaited feature is EIP 4895. That one is a big one because that's the one that's going to let users withdraw their stake from the beacon chain as well as any staking rewards they've earned. This is important because unless you're a validator on the beacon chain, there's no way to withdraw your funds or your rewards directly. So they use liquidity tokens to represent their assets. Another proposal is EIP 4844. This is another one that people have been waiting for because this proposal includes proto-dank sharding. And that means more data can be processed on the network. That brings gas fees down for everyone. Another proposal deals with the Ethereum virtual machine, specifically the part that handles smart contracts. EIP 3540 would mean that the code and the data from those smart contracts can be separated. It will also make it easier to upgrade the EVM in the future. Now, keep in mind, these are all just proposals of things that may be included in the testnet for the next upgrade to Ethereum. I suspect this list is going to be very fluid for a while as they work their way through the issues. Some things may be dropped for a future upgrade. Other things may prove unworkable altogether. So Binance has a mining subsidiary called Binance Pool, and Binance Pool has launched a new project. This is a $500 million program to support the crypto mining industry. What this means is private Bitcoin miners can go to Binance Pool to get a loan. Specifically, a Binance spokesperson said, quote, "One of the requirements is that the applicant must be classified as a Binance VIP user and connect at least 500 petahash per second to the Binance Pool for a minimum of 24 months after the loan is issued." Now, Binance is offering 18 to 24-month loans with 5 to 10% interest rate, and also collateral, physical or digital assets to act as a security deposit. And when evaluating potential clients, they're going to be looking at a number of things. Some of those things include what their current performance is looking like, and what kind of hash rate are they bringing to the table? What's their security like? Is it adequate, or did they just leave the default settings on? Binance is also launching a cloud mining product, and this means that purchasing cloud mining hash power from Bitcoin mining and digital infrastructure providers. Now, no word yet on the maximum amount one can borrow in a single loan. The company said that they would take it on a case-by-case basis, individually assessing each applicant's situation. In other Binance-related news, not quite so pleasant, new allegations have surfaced around Binance's regulatory setup. So there was this report published today by Reuters, and it said Binance, quote, swerved scrutiny, hiding from regulators in both the UK and the US. And in this report, the main thrust of it comes from two specific instances. First, Reuters told a tale of Zoe Wei. Now, Zoe Wei is Binance's strategy executive. She put forth a proposal to backdate a service agreement involving various operations between Binance's UK and Cayman Island holdings. And the reason why they proposed doing this was to avoid having to register with the Financial Conduct Authority. So if you were in business prior to January 10th of 2020, you had another year before you could register. Second one really isn't even about Binance, but one of their consultants, Harry Zhao. And Zhao presented a proposal in November of 2018. This would allegedly shift enforcement's attention to a U.S. entity instead of Binance proper. This proposal may have come because of the ban on onboarding U.S. customers, because it's said that they knew that there were still U.S. users on their main platform. Now, this report drew a swift rebuttal from CZ, and he took exception to the report as a whole. He did specifically address the proposal put forth by Henry Zhao. He said, quote, "Let me state clearly once again for the record, it was never implemented. I personally rejected it." Now, as far as exchanges' inner workings go, CZ pointed out Binance's rapid market growth for a short period of time. He said, quote, "There isn't a manual that explains how to immediately pivot from a small startup to a Fortune 100 organization, but we're learning fast." Representatives from the exchange have not commented on their conduct in the United Kingdom. On the subject of crime, the Lazarus Group is in the news again, this time in the country of Japan. Their national police are blaming the North Korea hacking group for years of crypto-related cyber attacks. So Japan's Financial Services Agency and their National Police Agency put out a joint public advisory statement. They were warning the country's crypto businesses that they need to be more aware of the phishing attacks. And this advisory statement is something called a public attribution. Reportedly, this is only the 5th time in history that the Japanese government has issued one. See, the thing is, they usually don't name cyber attackers before they've arrested them, which makes sense in this case, because if they could arrest the members of the Lazarus Group, they would have already done so. They wouldn't warn them. In addition to phishing, they also use social engineering. So they'll do something like impersonate an executive of a company and try to get their unsuspecting employees to take the bait by clicking sketchy links or opening up malicious downloads. Quote, "This cyber attack group sends phishing emails to employees impersonating executives of the target company through social networking sites with false accounts, pretending to conduct business transactions. The cyber attack group then uses the malware as a foothold to gain access to the victim's network. And this is exactly what we saw them do in the Ronin attack. So they're warning businesses to keep their private keys in an offline storage and not to open attachments or click on hyperlinks without verifying the sender first. At minimum, these are things we should all be doing, right?" Anyway, multi-factor authentication was another suggestion, and while the National Police Agency confirmed Japanese-based digital asset firms have suffered attacks from the group, they wouldn't disclose any details. The Lazarus Group is suspected of being behind the $650 million Ronin Bridge attack and the $100 million Harmony hack. On the subject of crypto-related crime in Japan, their government has approved a cabinet decision. And this decision amends existing laws to prevent people from using crypto to get around money laundering laws. These are changes to their Foreign Exchange Act and the Act on Prevention of Transfer of Criminal Proceeds. In Japan's cabinet, which is their executive branch, they decided to move forward with those edits on Friday. Now, this follows a report last September from the Nikkei. This report said that the government was planning on making those changes, specifically targeting remittances in an effort to stop criminals from using crypto exchanges to launder money. For the last year, Japan has been working to implement the anti-money laundering measures recommended by the Financial Action Task Force. In the meantime, local exchanges have been working to curb the worst of the task force suggestions, stating that it's too expensive to comply with the rules suggested. So what these new rules mean is that crypto exchanges will share information like the name and address of customers when transferring funds between platforms. So from here, the revisions are scheduled to be submitted to Japan's legislature. Moving on from Japan, back to Europe, specifically France, because last night we were talking about Société Générale. They received approval from the AMF to provide crypto custody, as well as trading services, which for an old, storied, respected establishment bank to be offering crypto services is kind of a big deal. And then there have been a number of companies getting virtual asset service provider licenses in France. So it's no big surprise to find out that France is looking to overhaul their tax rules next year. Their finance minister said that they weren't going to just copy-paste existing rules and try to shoehorn them in. Finance Minister Bruno Le Maire did say that he was worried about a couple of things. One, of course, energy consumption. And the second is the potential for blockchain technology to replace the role of the euro. This comes after the EU recently put in place their own crypto framework, the Markets in Crypto Assets Law. That's the framework that lets crypto companies operate across the EU, providing they meet investor protection and stability guidelines. Le Maire said, quote, "We want to use the year 2023 to deepen our reflection with the stakeholders in order to identify if new adaptations to tax legislation are necessary. A straightforward alignment with the taxation of stocks is not necessarily a desirable goal." And in this country, Sam Bankman-Fried and FTX are back in the news again, this time amidst reports that they are being investigated by Texas regulators over potential securities violation. They have concerns about the yield-bearing accounts that FTX offers. And funny enough, this comes from fallout over Voyager Digital, because they're looking at those yield-bearing accounts based on a description of those accounts in a filing associated with Voyager's bankruptcy case. And it came up because FTX recently won the bid for Voyager's digital assets. Now, for their part, FTX said that they're working this out with the regulators. They said, quote, "We have been in talks with the Texas state regulator for a while. We have an active application for a license which has been pending, and we believe we are operating fully within the bounds of what we can do in the interim. We look forward to continue working with Texas." Now, like many companies, FTX offers a yield-bearing account, 8% for the first $10,000 deposited and 5% for the next $10,000 to $10 million. And Rotunda tried it out himself. He said that he was able to get an account through the FTX app to earn yield on Ethereum as well as funds transferred from his bank account. And that was enough for him. He said, quote, "Based upon my earning of yield and an ongoing investigation by the Enforcement Division of the Texas State Securities Board, the yield program appears to be an investment contract, evidence of indebtedness and note, and as such appears to be regulated as a security in Texas." And he points out that it's not just FTX. Voyager is also under investigation by Texas regulators based on their yield-bearing accounts as well. Now, sticking with SBF here, because he said that he's in favor of testing. He said that he supports a knowledge test for derivative retail consumers. He said that it could make sense, but it doesn't have to be specific to just crypto. This kind of started with the Commodities Future Trading Commission, Christy Goldsmith Romero. On October 15th, she suggested the establishment of a classification of retail trader. We talked about it here. She believes that adding such a category could give greater consumer protections. It's Romero's view that crypto is creating more retail investors, and those investors are entering the derivatives market and getting wrecked. She said that the solution was to separate institutional and retail investors and to have, quote, "disclosures written in a way that regular people understand or could be used when weighing rules on the use of leverage." Now, Sam Bankman-Fried said that he 100% agrees with that. He said knowledge tests for all future commissions, merchants, and designated contract markets that work with retail traders. However, he doesn't think it makes sense for this to be specific to cryptocurrencies, suggesting that such a scheme should apply to all derivative products. Sam's thoughts are relevant here as FTX US is already planning on launching crypto derivatives trading. He said that they've already created a knowledge test that could be used for that platform. And I think that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.